Hi, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for September 28th of 2025. First chart we have today is a plot of economic growth relative to non-farm payrolls, NFP. So in other words, we're looking at economic growth relative to the labor market. And a lot has been written here lately as the labor market has cooled a bit. We've been discussing this for a number of months now, really kind of in anticipation of some of the overall tightening of the balance sheet that we've seen the Federal Reserve and running higher interest rates for a little bit longer for fear of tariffs, so on and so forth. But labor market weakness has given the Federal Reserve some cover to reduce interest rates here, even though they have a dual mandate of stable prices and stable employment. You can clearly see here that this more recent trend line in labor in non-farm payrolls has been down. You can see that this is in the thousands here, and so this is a shift. If you're looking over the last couple of years, it might not be as perceptible, but clearly over the last call it the last year. Really, I'd say the year to date, we've had a noticeable decline in payrolls. Now, that's set against the backdrop here of a kind of an average real GDP growth. If you did a trend line back to the beginning of this chart in September 21, the line of best fit would look right about here. Now, arguably, we have had a lot of noise in the data, and so a lot of it really related to tariffs. Is that at the beginning of the year, first quarter GDP was actually negative. Second quarter GDP was kind of a bounce back post tariff announcements. But clearly, the story here is that labor is moving slower. And even in that last data print for economic growth, it looked higher. Now, generally, when you do see like anomalies where these things are deviated quite a bit, you do have a reversion back to the mean somewhere. And so I think that's what everyone's looking for, is that are we going to get slower growth, or are we going to get labor settling out? I think labor is going to be kind of at a weaker point unless we see more meaningful rate decreases, whereas I think economic growth is probably going to remain, a little bit higher, but perhaps lower than what we've seen here recently, in particular the second quarter. We have a recession outlook. This is a probability forecast, and we've had some gyrations in this as well. I mean, not too long ago, we were talking about in recession probabilities that were closer to 40%. Certainly, we're talking about them a lot in 22, 23. But as the numbers go right now, we're probably closer to 30%. And, that's certainly elevated. If you look at the line of best fit and you take out the recession, the actual recession and the post-recession environment around the pandemic, then that line of best fit is probably about where we are now. And so, again, 30% is relatively low. It's very, very unusual to see recession probabilities like at or near zero. And in this case, it's not even zero, it's 10%. So lower level of recession, not out of the woods. Obviously, we have a dual mandate of stable prices and stable employment. And we just talked about the employment situation. We'll talk about prices here in just a second. Here we have bank credit growth. This is one of those indicators that gives you a sense of where the overall economy is, by looking at what bankers are feeling about their own prospects and their own balance sheet and loan committees and what they're thinking. So we have actually seen some expansions in bank lending. This is, coincidental to the first Fed rate reduction here. And again, obviously, we've been on a bit of a pause lately, but that bank credit looking a little bit higher, even though it may be subdued to the historical trend line. So this is actually a percentage year over year change. And so when you look at it where it is now, we're about 5% year over year. But you can see here that in between recessions, you generally get an acceleration of that growth. And again, this is the last recession here. Then we've had some false positives and false bottoms here. So again, looking relatively healthy. On this slide, we have a little bit of insight on perhaps why retail sales and consumption is kind of holding in there a little bit. We have from the New York Fed, we have the credit card debt at essentially $1.2 trillion dollars. And as you can see here, going back to basically about 2018, that it is the highest on record. And so consumers are continuing to leverage up. Don't know what that means necessarily, for the evolution of the credit cycle, although, reading the tea leaves, it would suggest that at some point can't be sustainable. And then you're going to have consumers running into a little bit of a credit crunch. You're going to see delinquencies, particularly on these types of instruments, go up a little bit, and you're going to see overall consumption way down a little bit. And so, a couple of slides ago, we were talking about GDP. That's why I feel like maybe we should be able to maintain positive GDP, barring something unforeseen right now. But it's going to be lower because I think overall consumption and consumer spending is going to be reined in because they're not going to have this lever to pull forever. Share of euro in global foreign exchange reserve holdings. This is kind of a measure of the confidence in the dollar, which we talked about a lot in April and May following the tariff tantrum. As you can see here, really not much change. And, this is kind of like remarkable in the sense that it really is unremarkable in the rate of change. Now, if you would have, been sitting here in April, you would have expected this to jump higher, as people move out of dollars and move into euro. Obviously, the dollar's been weak, but again, overall, we haven't seen a big change there in the share of euro in reserve holdings in central banks around the world. Goods inflation, we see here is moving a bit higher. It had been subdued for a while. We do see service sector inflation really still elevated, but at a decelerating rate. So when we look at year over year numbers, I mean, we've got service sector inflation that's about 4%, and you've got goods sector inflation that's probably about 2% here. So, or maybe closer to 2.5. These are trending towards each other. Be interesting to see if they actually eclipse. And we see these inflection points before. But again, suffice it to say that we're seeing some reacceleration in inflation out of the goods sector. Here we have a measure of where this embedded inflation is. Again, I speak to this topic because it is interesting that we had the Fed rate decrease here recently, and you had the estimates for continued rate increases, like 2 more rate increases heading into 2026. Now, again, the last slide we talked about goods inflation kind of accelerating a bit. We've talked about service sector inflation kind of weaning back a little bit, but this is a data series here from Apollo. It's basically the CPI components, the percentage of which that are rising faster than 2% on an annualized basis month over month. And you can see, we went from 60 back here in May to about 70% of all of the CPI components are now above 2%. So that's a big reason why we're seeing a little bit of uptick in inflation. And I'm not sure that we've really seen the full front of the I think we might be in the eye wall, so to speak, on tariffs to some degree, but I'm not sure that we've seen the final word on what that's going to do to inflation just here over the near term. But it is clear that in a relatively few short months that we have seen quite a number of the components in the CPI, the Consumer Price Index, that are rising faster than 2%. Now we have some retail sales and consumption data to share with you. We were talking about that on the last slide. That we've got retail sales year over year that seem to be moving higher. We have overall consumption on a 4-quarter moving average here that is trending a little bit lower, although consumption, as it were, in the second quarter is up significantly over the first quarter. Another data point on confidence in the U.S. Here we have foreign holdings of U.S. equities, and they are at a record. This is actually pretty remarkable. April, January, to April, and this was the tariff announcement, and then that did go down. We did have some disintermediation. That's something that I think we all, were worried about, that there was going to be a flush of people unloading dollars, exacerbating the dollar weakness. That hasn't happened. And in fact, I think a few weeks ago, we had another chart of the week that talked about foreign direct investment and investment in the liquid equity markets that showed basically the same trend, that it's moving up, not down. So if anything, you've got more foreigners, more foreign investment in the U.S. stock market. Talking about the market a little bit, we've been now basically about 110 sessions almost. This is data through Friday from Bloomberg, so almost 110 sessions without a 2% drop in the S&P 500. And as I've said often, market volatility is something that should be embraced and acknowledged. It does happen. On average, you get about a 2-3% correction about 3 times a year, and we just haven't had one in quite a while. And you think about 107 sessions here, and divide that by 30 days on average, and that tells you it's been a few months since we've seen this. And so I do think there is a case to be made, given some of this data, that the markets have just gotten a little bit ahead of themselves, in terms of enthusiasm. And obviously, we talked a lot about the concentration of the S&P 500, the heavy dominance of tech stocks, and how the specter of lower interest rates probably offsets some of that volatility a little bit. But certainly, there's a lot of expectations that are priced into the market that could result in a bit of a near-term correction here. Here we have the S&P 500 continuing to move higher. Again, liquidity fueled. As we've talked about, there's like $8 trillion of money market funds that are sitting on the sideline. There's a lot of dry powder. There's actually a fair amount of liquidity, and as we just saw, that there's a lot of foreign interest in the U.S. market. So a lot of price action in the S&P 500, and it continues to kind of move higher from strategic forecasters. Again, we entered the year, I think they were way too optimistic, which is, it's a behavioral bias that sometimes you get, even the practitioners are overly enthusiastic and overly optimistic, and that was the case here. April, that got ratcheted down. Market did course correct and has reaccelerated beyond the level of strategist forecast. So, it's not atypical for forecasters to get a little ahead of themselves. I think this market has done a remarkable job coming off of its trough, but essentially reattaining its directional line here. And I would expect that the longer this persists, the more that you're going to see a rise in expectations out of S&P forecasters. Here we have really a chart that kind of talks about the phases of the economy. And so, question is, where are we, and what does that mean for expected returns? So this is Bloomberg Intelligence's economic regime model. So and this is what's going to happen to essentially at the S&P 500 projected. Let me rephrase that. What's projected to happen in the S&P 500 in 3 months, 6 months, and then 12 months looking ahead. Now, we are in maybe a little bit of showing weakness period here. I'd say we're somewhere in this phase. I wouldn't say the economy's weak, because we do have some measures of the economy. They're actually relatively strong. We're certainly not in a recession, and I would say, weak economy is not it. So we're kind of like maybe in this range, if you will, kind of in the middle. And so what does that say? Well, on average, this model would suggest, basically 2 to 3% growth over the next 3 months in the S&P 500, about 6% growth over 6 months, and then somewhere between 12.5 and 14% over the ensuing 12 months. So this is just a guide. It's not meant to be an absolute. I did find it interesting because it's a model that actually has a lot of robustness built within it. And so, as you would expect, near-term returns are not nearly going to be as aggressive as ones that, when you typically move out of recession. So, and you typically have stronger net growth looking ahead over at least, 12 and certainly 24 months when you're in a recession because you're already at the trough. We have next 12 months PE, price to earnings ratio. You can see that we are relatively elevated. It's actually moved up a little bit more. We're probably more like 23 times earnings. You can see going back to 1996 and the tech bubble that we're not quite into that nosebleed territory. We're awfully close. We did see this coming out of the pandemic, and so those reversed in 22. Uh, so, more fuel to the argument that, we're a little frothy here. We're not as, as egregiously out of line as, back in the tech bubble. But again, the S&P of today is not the S&P of the tech bubble. There's a lot more concentration. We did have, interest rates were higher back here, and there was a lot more kind of room for weakness and really a basic acknowledgement of a lot of the tech firms that were achieving these high multiples didn't really even have solid business plans, let alone earnings, let alone sales, even in some cases. So frothy market, not egregiously so, but one that gives me a little bit of pause and adds a little bit more fuel to the argument that we're going to get, that we're apt to have a correction of some sort here. Stock bond correlations, we've talked a lot about that. Over time, the kind of the leadership has changed on this. For a long time leading up to the tech bubble, stocks and bonds actually had a positive correlation. Not generally the line of best fit. It would be like maybe zero point 0.3, which is not a high correlation. Managing using bonds for risk is a time-tested tool. However, you really want to see more negative correlation, and so that kind of correlation actually worked real well after the millennium for quite a number of years. The average line of best fit here is probably negative zero point 0.4. So you can see how bonds were negatively correlated with stocks, and then here recently we've kind of passed up through that. 2020 pandemic, moving forward, we've actually had more positive stock and bond correlations after the pandemic. And we talked a lot about gold last week, and so this is gold as a percent of developed market liquid wealth, and we're up to basically like 7-8%, and that's because gold is taken on a new luster, so to speak. No pun intended actually. But also the demand for gold has gone up quite a bit, and so um, demand and prices are what's driving this uptick here. And again, gold is very important. So we're going to end the last two charts on talking about alternatives. This slide from JP Morgan really just kind of highlights the power of diversification and alternatives. We have begun to layer these into client portfolios, certainly into like trust type portfolios and very long duration portfolios, endowments, foundations, things like that. And I just want to illustrate what all alternatives do for you. And again, there's the definition of alternatives is pretty broad, and I'm not going to go into that here. But suffice it to say, if you had a more aggressive portfolio, call it 80% equities, 20% bonds, and we're on a chart that's plotting annualized volatility versus annualized returns. So this particular portfolio over time is apt to generate an annualized return of around 8%. Again, think about stocks generating close to 10, bonds generating 5.5, if you will, just in a very, very generic sense. So weighted average there gets you to about 8%. Now that comes with about 13.5% volatility. And again, that's a high volatility. The more stocks you have, the more volatile your portfolio is going to be. But if you were, say, for instance, to add 20% of alternatives to that portfolio, well, you've taken volatility from 13.3 down to something that looks a lot more like, 10.8 or maybe even 11. And in addition, you're able to eke out some extra return. So you're, instead of really kind of 8% here, you're looking at something that's a little bit north of that. And similarly, if you talk about like the 60-40 portfolio right here, again, you have annualized return just north of 7 with an average annual volatility of around 10%, right? So you're already, from this portfolio to this portfolio, you're getting some diversification, but you're giving up returns. Now, if you add 20% of alternatives to that, and I'd say in each of these cases, we're not, adding 20% of alternatives to our portfolios right now, but really just for illustrative purposes, if you were, then what happens here is that your return actually goes up closer to 8%, and your volatility again goes down, something closer to 9%. And the same thing happens when you have more conservative portfolios here, and your return, again, in those cases too, return actually goes up, volatility goes down. So that's the theme. Returns go up, volatility goes down. That's why we look at alternatives. So the other thing that we're looking at here is private capital. Some slides again from JP Morgan in their guide to alternatives, and a couple things I'll kind of show here. We have had some interesting gyrations in the market. We had a lot more private capital fundraising that happened in the post-pandemic environment that continued to trail off. And you can see the different sleeves here. Private equity continues to be, probably the lion's share of all of this, but we also have venture capital, private credit, real estate infrastructure, and to a much lesser degree, we have natural resources. But we do have a lot of uninvested capital here. So when you think about this in several different sleeves, right? So you have the stock market, you have listed public equities, but then you also have, of course, a lot of private companies. But this tells us that there's a lot of dry powder looking for companies to buy. So the supply of private companies is infinitely greater than the supply of public market traded entities. And the additional thing here is that there's a lot of dry powder, not just for that private equity side, but also for private credit here too. And you've heard me talk about like the non-bank sector. Well, even though bank lending seems to be up, and the SLUs, the loan officer surveys, have indicated maybe some relative modest loosening of credit to borrowers, that you still have a lot of people that are coming to the private sector for that same type of borrowing. Now they're paying a little bit more, but it's generally with a lot less red tape, and you're paying essentially for that convenience factor. But again, the takeaways here, really not so much that we've had a decline in fundraising, but I think this is really, cause and effect here, because you've had lower fundraising, but you've got a lot of dry powder looking for a home. And I think that actually bodes well for the public markets as, maybe companies get taken private. It certainly bodes well for M&A, mergers and acquisitions, over time. And I think it also bodes well for the robustness of credit availability for capital expansion, particularly if interest rates are coming down. That's all the charts we have this week. Hope you've enjoyed them. Have a great week. We'll talk to you again soon.